Most people hear that investment bonds can be tax-free after 10 years and assume that means they're automatically a good strategy. But in reality, using the wrong structure here can cost you tens of thousands over time. And that's why this matters. Because this isn't just about picking an investment, it's about where you hold that investment. And that decision directly affects your tax, your flexibility, and your long-term outcome. So if you've ever come across investment bonds, or someone suggested them for you or your kids, it's worth understanding where they actually fit and where they don't. Now, at a simple level, an investment bond is just a structure. It's a way of holding investments, not an investment itself. Inside that structure, your money is invested, and any earnings are taxed internally, up to a maximum of 30%. So instead of you declaring income in your own tax return each year, the bond handles the tax within that structure. And then there's the part most people focus on. If you hold the bond for 10 years, you can generally withdraw the money tax-free. That's the headline feature. But here's what most people miss. That doesn't automatically make it better. Because the key question isn't just, is it tax-free later? It's what tax are you paying along the way? And compared to what? This is where it becomes important. If your personal tax rate is higher than 30%, then having earnings capped at that level inside the bond can be helpful. But if your tax rate is lower than 30%, you might actually be paying more tax than you need to. And over 10 or 15 years, that difference can add up in a meaningful way. So already, whether this works for you or not depends on your tax position. The next piece is time, because the 10-year rule only works if you actually leave the money there. If you access it earlier, some of those tax benefits can unwind, and it becomes a very different outcome. I've seen people set these up thinking they're long term, but then life happens, and they need access in year 5 or 6. At that point, the structure they choose starts working against them instead of for them. And this matters more than it seems. Because when you compare this to something like super is often more tax effective again. So one of the more common mistakes is using an investment bond when super would have been the better environment. Not always, but often. Now, there are a few situations where bonds can make sense. If you're on a higher tax rate and you're confident the money is genuinely long term. If you want something simple where you don't want to have to deal with annual tax reporting. Or if you're investing for a child and want to avoid the penalty tax rates that can apply in their name. And there's another angle here that doesn't get talked about as much. Investment bonds can also play a role in wealth protection. Because the assets sit within the bond structure rather than being held directly in your personal name, that can create a layer of separation, which in some situations can be useful, particularly around estate planning or structuring. But it's important to be careful here. That benefit depends heavily on how things are set up and your broader situation. So it's not something to assume, it's something to think through properly. Now on the flip side, there are a few trade-offs that are easy to overlook. Fees can sometimes be higher than holding investments directly, and you're also giving up some flexibility compared to investing in your own name. There are also rules around how much you can contribute each year, including something called the 125% rule, which limits how quickly you can increase contributions over time. But an important detail here, if you skip a contribution in a year, you break that pattern, and you can't continue increasing contributions under that rule going forward. So it's not just about how much you invest, it's about maintaining consistency as well. So again, this isn't a set and forget structure, it's specific, and that's really the theme here. Investment bonds aren't good or bad, they just suit certain situations and don't suit others. So when you're thinking about whether one makes sense, it really comes back to a few practical things. What tax rate are you actually paying today? Are you realistically going to leave that money invested for at least 10 years? What's the purpose of the money? Is it for retirement or kids or just general investing? And how does this compare to your other options, like your super or investing in your own name? Because in a lot of cases, the better outcome doesn't come from picking a good investment, it comes from choosing the right structure around it. So if you take one thing away from this, don't just focus on the tax-free after 10 years headline. Look at how it actually fits your situation, your time frame, and your tax position. Because that's what determines whether it works or quietly works against you. This is general in nature, so it's important to consider your own situation before making any decisions. And if you want to implement this properly, I help Australians structure this every day. Details are below.